Welcome back to the deep dive. Today we're jumping into something absolutely critical if you're actively trading U.S. options.
That's right. We're talking taxes.
Exactly. And look, our sources are really clear on this. For an active trader, understanding the tax side isn't just paperwork you do later. It's fundamental to actually being profitable.
It really is. It's an integrated part of your strategy, or at least it should be. We're going to focus especially on how the IRS looks at things when you're selling premium, like calls and puts.
Because getting this wrong can seriously eat into your returns, right?
No, absolutely. Weeks, maybe months of good trading can be undermined if you don't grasp these nuances. So, let's make sure that doesn't happen to you.
Okay, let's start with the basics, the foundation, capital gains. Before options even enter the picture, we need to get this part straight. How does the holding period work, and why is one single day so important?
It's kind of a sharp dividing line, isn't it? The IRS is very precise here. Your holding period starts the day after you acquire the asset.
Yeah.
Not the day of, the day after.
Right.
And it ends on the day you sell it. Now, if you hold that asset for 1 year or less so, 365 days or fewer, any gain or loss is short-term.
And short-term means taxed, like regular income.
Exactly. At your ordinary income tax rate. That could be anywhere from 10% up to 37%, depending on your tax bracket for the year. Pretty steep.
Yeah, that's high.
But if you manage to hold that asset for more than 1 year, meaning 366 days or more, then it becomes long-term.
And that's where the big advantage kicks in.
That's the preferential treatment. Long-term capital gains are taxed at much lower rates, 0%, 15%, or 20%, again, depending on your overall income level.
That difference between, say, 37% and 20%, that's a massive incentive to hold on just one more day sometimes.
Huge incentive, especially for people in higher income brackets. It can make a world of difference to your net profit.
Okay, but trading doesn't always mean profits. What if you net everything out for the year, all your buys and sells, and you actually end up with a loss?
Yes. That brings us to a really important rule. The capital loss limitation. If your total capital losses are more than your total capital gains, you hit a ceiling on how much you can deduct against your other income.
Other income like salary.
Exactly, like your salary, wages, that sort of thing. You can only deduct a maximum of $3,000 of that net capital loss against your ordinary income in any single tax year.
Only $3,000. So if I have a really bad year and lose, say, $20,000 trading stocks, I can only use $3,000 of that loss to reduce my taxable salary income that year.
That's precisely right. The remaining $17,000 isn't lost forever, though. It gets carried forward.
Carried forward.
Yeah, you carry it forward to future tax years, indefinitely, actually, until you can use it to offset future capital gains. But you can only use that $3,000 per year against ordinary income.
That's a pretty tough limitation for someone just starting out or having a rough patch.
It is. It's a structural reality you have to plan around.
Yeah.
And it really sets the stage for why understanding the options rules is so vital, especially for sellers.
Right. This is where it gets, maybe a bit tricky for the income-focused trader. Let's say I sell a cash-secured put or maybe a covered call, and the option either expires worthless or I decide to close it out early for a profit. How's the IRS treat that premium I collected?
Okay, this is fundamental. There's a universal rule for closing or expiring short options.
Yeah.
And it's not always what people expect.
Oh.
Any gain or loss you realize from a short option when you wrote that you either close out by buying it back or that just expires worthless is always treated as a short-term capital gain or loss.
Wait, always short-term. What if I wrote, say, a late PS call, one that doesn't expire for 2 years, and maybe I close it after 18 months for a profit? That's still short-term.
Yes, still short-term.
But why? I held the position open for over a year.
The IRS sees it differently. Their rationale is that when you write an option, you're not really holding a capital asset in the traditional sense. You're taking on an obligation.
An obligation to buy or sell stock later.
Right. And when that obligation is extinguished, either because you buy it back or it expires, the gain or loss is realized then. And the rule just says that realization is always short-term. It doesn't matter how long the option was open.
So that premium income gets taxed at my highest marginal rate. That's a significant tax drag for premium sellers.
It's a major structural inefficiency from a tax perspective if your goal is generating income through selling premium. You're constantly fighting that short-term tax rate unless
assignment happens.
Exactly. That brings us to the third possibility, assignment. And this is where the IRS logic gets, let's say, counterintuitive but actually helpful for the taxpayer.
Okay, so assignment getting exercised on a short put or called away on a covered call. What's the core principle here?
The absolute key principle is assignment itself is not an immediate taxable event.
Not taxable right away?
Nope. You don't calculate a gain or loss on the option at the moment of assignment. Instead, it's treated as a basis adjustment event.
Basis adjustment, meaning?
Meaning the option transaction basically disappears and gets merged into the resulting stock transaction. The tax impact is deferred until you eventually sell the stock involved.
Okay, that sounds important, but maybe a bit abstract. Let's walk through the two main scenarios with some numbers.
Good idea. Let's start with scenario 1. You sold a cash-secured put, and the stock price dropped, and you get assigned. You're forced to buy 100 shares.
Right.
Okay, remember that premium you collected when you first sold a put?
Yeah, let's say I got $300 for it.
Perfect. And let's say the strike price was $150, so you have to pay $15,000 for those 100 shares at assignment.
Okay.
That $300 premium you received, it's used to reduce your cost basis in the stock you just bought. So your actual tax basis isn't $15,000. It's $15,000 minus the $300 premium. So $14,700. That's your official starting point for calculating gain or loss when you eventually sell those shares.
Ah, okay. So the premium effectively makes the stock cheaper for tax purposes, and the tax event only happens way later when I sell the stock.
Precisely. And the holding period for that stock begins the day after assignment.
Got it. Now, scenario 2. I own stock. I sell a covered call against it. The stock price rallies, and I get assigned. I'm forced to sell my shares.
Okay. Similar logic, but kind of in reverse. Let's say the strike was $45, so you're selling 100 shares for $45,000. And let's say you collected a $500 premium for selling that call.
Right.
That $500 premium is added to the strike price to calculate your total sales proceeds. It's like you sold the stock for a bit more than just the strike.
So my proceeds aren't $45,000. They're $45,000 plus the $500 premium.
Exactly. Your adjusted sales proceeds for tax purposes are $45,500. That's the number you use to calculate your gain or loss against your original cost basis in the stock.
And the character of that gain or loss, short-term or long-term, what determines that? Is it how long the option was open?
No. Crucially, it's not about the option's holding period here either. It depends entirely on the holding period of the underlying stock you were forced to sell.
So if I held that stock for, say, 5 years before selling the call and getting assigned,
then the resulting gain or loss on that $45,000 to $500 sale is long-term, benefiting from those lower rates. The option premium essentially inherits the tax character of the stock transaction it gets merged into.
that's a huge benefit. Assignment basically converts what would have been short-term premium income into something deferred, or potentially even long-term gain.
It's a fundamental shift in the tax treatment. But, as we'll discuss, it's often missed if you're not careful.
Okay, so we've established that the always short-term rule for closing or expiring options is a big hurdle for income traders, but assignment offers a way around it by merging with the stock. Is there any other way for really active traders to get relief from high short-term gain taxes without relying solely on assignment?
Yes, there is. And this is where things get, well, quite advantageous if you trade specific products. We need to talk about Section 1256 contracts.
Section 1256. Okay, what falls under that?
This generally applies to regulated futures contracts, foreign currency contracts, and importantly for our audience, certain options, specifically options on broad-based stock indexes.
Broad-based indexes, like the S&P 500.
Exactly. Options on the S&P 500 index itself, the SPX, or the NASDAQ 100 index, NDX, or even the VIX index, but not options on the ETFs that track these indexes, like SPY or QQQ.
Hold on. So if I trade options on SPY, the S&P 500 ETF, that's just a regular equity option subject to the normal rules we discussed.
Correct. Normal rules apply.
Yeah.
Short-term if closed or expired. Basis adjustment on assignment.
But if I trade options on SPX, the actual index, even though it tracks the same thing, the tax treatment is completely different.
Profoundly different. SPX options are Section 1256 contracts. And the big advantage is the 60-40 rule.
60-40, what does that mean?
It means that regardless, and I mean regardless of how long you hold the position, even if it's just for 5 minutes in a day trade,
Wow.
any capital gain or loss you realize is automatically treated as 60% long-term and 40% short-term.
Automatically, just like that.
Just like that. It's a blended rate built right into the tax code for these specific contracts.
That seems incredibly favorable. Why does the IRS do that?
Well, the history goes back to futures markets.
Yeah.
And trying to simplify taxing these highly leveraged, often very short-term instruments. They basically decided on this fixed blend as a compromise.
Yeah.
But for an active options trader today, it's a huge tax break compared to trading standard equity options.
Let's put numbers on that. Same scenario as before. A top bracket trader, maybe 37% ordinary rate, 20% long-term rate. They make $10,000 profit closing out an SPY option. That's short-term, so tax is $3,700, right?
Correct.
$3,700 tax.
Now, what if they made that exact same $10,000 profit trading an SPX option, closing it out just as quickly?
Okay, apply the 60-40 rule. 60% of the $10,000 gain, which is $6,000, is taxed at the long-term rate of 20%. That's $1,200 tax.
Okay.
The other 40%, which is $4,000, is taxed at the short-term rate of 37%. That's $4,480 tax.
Right.
Add those together. $1,200 plus $4,080 gives you a total tax of $2,680.
So $2,680 on the SPX gain versus $3,700 on the SPY gain. That's over $1,000 saved on the exact same $10,000 profit just by trading the index option instead of the ETF option.
Precisely. Your effective blended tax rate drops significantly, down to about 26.8% of this example, instead of the full 37%. It's a massive difference if you trade frequently.
And there's another benefit to Section 1256, too, isn't there? Something about wash sales.
Ah, yes. Another huge advantage. Section 1256 contracts are explicitly exempt from the wash sale rule.
Which normally stops you taking a loss if you buy back the same thing too soon.
Exactly. The wash sale rule usually disallows a loss deduction if you acquire substantially identical securities within 30 days before or after the sale that generated the loss. But with 1256 contracts like SPX options, that rule just doesn't apply.
So you can take a loss on an SPX position and immediately reestablish a similar position without having that loss disallowed.
Correct. It gives you much more flexibility for tax loss harvesting and risk management throughout the year.
Okay, so the rules are complex. We have the always short-term rule, the basis adjustments on assignment, the 60-40 rule for index options. When tax time comes, how much help do we get from our broker? Can we just trust the Form 1099-B they send?
That would be nice, wouldn't it? But unfortunately, no. You absolutely cannot blindly trust the 1099 method for options, especially when assignments are involved.
Really? Why not? They track the trades.
They track the trades, yes. But the reporting systems often fail. I'd say usually fail to correctly apply the basis adjustment rules for assignments that we just discussed.
So in that put assignment example, where my basis should be $14,700, what will the broker likely report?
The broker will almost certainly report your cost basis as just the $15,000 strike price payment, completely ignoring the $300 premium you received that should have reduced it.
And if they report my cost basis is too high?
Then when you eventually sell those shares, your calculated gain will look $300 bigger than it really is, or your loss will look $300 smaller. You'll end up overpaying your taxes.
And for the covered call assignment, where my proceeds should be $45,500.
Similarly, the broker might just report the $45,000 strike price proceeds and ignore the $500 premium that should have been added. In that case, your reported gain would look too small, which sounds good, but it's technically incorrect reporting.
So the numbers on the 1099-B can be wrong in either direction, depending on the assignment type.
Yes, and the crucial point is the IRS puts the legal responsibility squarely on you, the taxpayer, to report the correct numbers, regardless of what the 1099-B says.
Okay, so if the 1099-D is likely wrong for assignments, how do I fix it on my tax return?
You have to make manual adjustments using Form 8949. This is the form where you list out all your capital asset sales before they flow onto Schedule D.
48949.
Yes. It has columns specifically for adjustments. You report the incorrect basis or proceeds from the 1099-B, and then you use an adjustment code, usually code B, for basis reported incorrectly, and enter the correction amount.
So I'd manually subtract the put premium from the reported basis, or add the call premium to the reported proceeds right there on Form 8949.
Exactly right. You have to actively correct the broker's figures to reflect the proper tax treatment of assignments. If you don't make these adjustments, you're filing an incorrect return, and you're likely paying the wrong amount of tax. Diligence here is absolutely key.
Wow. We've certainly covered a lot today. From the basic holding periods, that tough $3,000 loss limit, the always short-term rule versus the non-taxable nature of assignment, and then the big 60-40 benefit for index options. It really drives home the need for careful record-keeping.
It really does. The system rewards that diligence. Just remember the core concepts. If you close a short option or it expires, that's always short-term gain or loss. But if you get assigned, the option disappears into the stock transaction, and the tax character short-term or long-term follows the stock's holding period. And if you're trading Section 1256 index options, you get that nice 60-40 split automatically.
Okay, for a final thought, something to chew on, we talked early on about that $3,000 capital loss limitation, how restrictive it is. Is there an ultimate move some very serious professional traders might make to get around that limitation entirely?
Ah, yes. There is a path, but it's a significant commitment. They can pursue what's known as trader tax status, or TTS.
Trader tax status, what does that involve?
It involves meeting pretty stringent IRS tests regarding the frequency, regularity, and continuity of your trading activity.
Yeah.
Basically, you have to demonstrate you're running a trading business, not just managing investment.
Okay. And if you qualify for TTS...
If you qualify, you then have the option, it's an election you have to make proactively, to use Section 475 mark-to-market accounting.
Mark-to-market, Section 475. That sounds serious. What does it do?
It fundamentally changes everything about how your trading gains and losses are treated. They stop being capital gains and losses altogether.
So they become...
They become ordinary income and losses, just like business income.
Ordinary losses. Wait, does that mean...
Yes, that's the huge upside. If you elect Section 475 mark-to-market, the $3,000 capital loss limitation completely disappears for your trading activity. If you have a disastrous year and lose, say, $100,000 trading, you could deduct that full $100,000 against your other ordinary income, like a spouse's salary or prior business income in that year.
Wow. Unlimited loss deduction against ordinary income. That's powerful risk management.
It's primarily about catastrophic risk management, yes, but there's a major trade-off, of course.
There always is. What's the downside?
The cost is giving up all preferential tax rates on your gains. Since everything is now ordinary income, even if you held a position for 5 years, any profit is taxed at your highest ordinary income rate, potentially 37%. You lose the benefit of the 0%, 15%, or 20% long-term capital gains rates entirely.
So you trade lower tax rates on gains for the ability to deduct unlimited losses.
Exactly. It's a strategic choice. You're prioritizing downside protection over optimizing the tax rate on your winners. It's generally only considered by very active, potentially highly leveraged traders who see it as a cost of doing business.
That's a really interesting high-level strategic decision, a true trade-off. Okay, well, as we always say, this has been an educational analysis based on our sources. It's definitely not investment advice or specific tax advice.
Absolutely. The rules are complex and your situation is unique. You should always consult with a qualified tax professional before making any big decisions or elections like Section 475.
Couldn't agree more. Thanks for joining us on The Deep Dive.